Have you ever wanted to invest in real estate, but just without the headaches of tenants, toilets, and those dreaded midnight calls about a broken water heater? Yeah, I've been there. It's not exactly the dream we've imagined when we think of passive income. Or maybe you've wondered how the banks always seems to win, no matter what's going on in the economy. The market goes up, the market goes down. But one thing stays the same. The bank still gets paid. Well, what if I told you that you could invest like the bank, earning steady, predictable income every month backed by real estate? That's exactly what mortgage note investing is all about. Hey, I'm Pienaar, the founder of Ritsel Notes, and in this video, we're going to talk about how mortgage note investing works, what it is, how you can profit from it, and why more and more investors are turning to it for truly passive income. By the end of this video, you'll see how you can safely step into the bank's shoes without needing millions of dollars and start building long-term, steady cash flow. Now, I know what you might be thinking. Mortgage note investing. That sounds complicated. I totally get that. When I first heard about it years ago, I thought the same thing. I figured it was only something Wall Street or big banks could do. But once I really understood it, it completely changed the way I look at real estate investing. Because here's the thing. When you invest in mortgage notes, you're not actually buying the property itself. You're buying the debt that's secured by that property. And that's a powerful position to be in. Think about it. If a homeowner misses a payment, who has the control? It's not the homeowner, it's the bank. And when you invest in notes, you basically become the bank. Now here's the exciting part. You don't need to be a giant institution to do this. Ordinary investors like you and me can buy notes through private deals, funds, or even online marketplaces. The barrier to entry is much lower than most people think. And that's why space has been quietly growing among smart, educated investors looking for stable income. Let's break it down into simple terms. When someone buys a house and takes out a loan, they sign two important documents. The first is the mortgage or deed of trust. That's what uses the property as collateral. The second is the promissory note, and that's basically the borrower's written promise to pay back the loan. That promissory note or mortgage note lists everything: the borrower's name, the amount borrowed, the interest rate, the payment schedule, and all the terms. So in plain English, it's an IOU, but one that's backed by a piece of real estate. Now here's where it gets interesting. Once that mortgage note is created, it doesn't have to stay with the bank forever. Banks often sell those notes so they can free up capital and issue new loans. They don't want to hold onto a 30-year mortgage. They rather recycle that money and lend it out again. That's how they keep the cash flowing. And that's where you and me as investors step in. We can buy those notes, sometimes at a discount, and in return, we start receiving the borrower's monthly payments. So instead of collecting rent as a landlord, you're collecting mortgage payments, like a bank. Now imagine this. Instead of one tenant renting your property, you have multiple homeowners across different states paying you every month. You're diversified. Your cash flow is steady, and you don't have to worry about roof leaks or plumbing repairs. It's one of the most passive ways to participate in real estate. Let me give you a quick example. Imagine John buys a house for $200,000. He borrows that amount from a bank and agrees to pay $1,200 a month for 30 years. Now, after a while, the bank decides to sell John's mortgage note. Maybe they want to use the funds for new loans, and you, as investor, buy it for, let's say, 198,000. John still owes the full 200,000, but now he's paying you instead of the bank. So every month, John sends that 1,200 payment to you. Over time, you earn interest income and you benefit from the 2,000 discount you got when you bought the note. You didn't buy the property. You bought the right to receive the payments secured by that property. And if John ever stops paying, you have the legal right to take ownership through foreclosure, because your investment is backed by the real estate. That's the beauty of it. You get both steady income and asset security. Another thing worth mentioning is that you can even invest through retirement accounts like a self-directed IRA. That means your note income can grow tax-deferred or even tax-free depending on the structure. It's one of the smartest ways to build wealth for the long term. Now let's talk about how note investors actually makes money, because there's more than just one way. First, there's interest income. That's your monthly cash flow, like rent payments, but without the tenants. And then there's buying it at a discount. Like in our example, when you paid 198,000 for a 200,000 note, that built-in equity becomes profit over time. Sometimes borrowers refinance or sell their homes. When that happens, they pay off the full loan balance and you get a nice lump sum, often more than you originally invested. You can also sell the note later, once it has a strong payment history, often for a profit. And if a borrower stops paying, you might take over the property through foreclosure. Not a goal, but it can turn into something that's a great opportunity if the property value have appreciated over time. So really, there are multiple ways to win. Steady cash flow, profit from discounts, and even equity through the property. And here's a tip. Some investors focus on creating their own notes by providing private financing to home buyers or real estate investors. That means you can structure that terms yourself. Choose the interest rate, the payment length, and the security, giving you full control over your investment. Now let's talk about why more investors, especially in today's market, are choosing mortgage notes. First is the passive income. No tenants, no toilets, no maintenance. You just receive payments. Second is the security. Every note is backed by real estate. Real collateral. Even if things goes wrong, you protect it. Third is flexibility. You can choose performing notes where borrowers are paying, or non-performing ones where they're behind and you can help them to get back on track at a deep discount. Fourth is the returns. You can often earn double-digit returns, especially with non-performing notes that you can get re-performing again. And lastly, diversification. You can spread your investment across multiple properties in different states. Think about it. Banks have been using this exact strategy for centuries. We're just following their blueprint, but on a smaller personal scale. When you invest in a note, you're not chasing the bank's money. You're becoming the bank. Now, some people hear note investing and immediately think, that sounds risky. But honestly, the risk depends on how you buy and how you manage your notes. You can do your homework. Check the borrower's payment history. Verify the property value. And review all the documents before you buy. That's the beauty of it. You're in control. You decide what you buy and at what price. Just like any investment, knowledge is power. The more you understand, the better your results. And the best part? You can start small. You don't have to go all in on your first deal. You can begin with 1 or 2 smaller notes, learn the ropes, and grow your portfolio at your own pace. Over time, that steady cash flow can become a reliable stream of passive income that supports your lifestyle or even your retirement. So let's quickly recap. A mortgage note is simply a borrower's promise to repay a loan, backed by real estate. When you buy a note, you're buying the right to receive those payments. You can earn through interest, discounts, payoffs, or even property ownership. You don't have to manage tenants or repairs, and your investment is secured by the property itself. Mortgage note investing allows you to grow your wealth passively, securely, and often with higher returns than traditional real estate. Hey, if you found this video helpful, don't forget to hit like, subscribe, and turn on that notification bell. Because in the upcoming videos, I'll share more like the difference between performing and non-performing notes, how to find your first deal, and how to manage risk like a pro. And if you want to dive deeper right now, head over to ritselnotes.com, where you'll find guides, resources, and opportunity to help you start investing just like the bank. I'm Pienaar from Ritsel Notes, and remember, real wealth doesn't come from owning more properties, but from owning the debt that pays you every month. Thanks for watching, and I'll see you in the next video.